and we know that the capital flow is very tricky, also very volatile, but extremely important issue for emerging market economy. And my understanding, or our understanding, especially my understanding of this issue, is very limited. So we're really fortunate today to have a very distinguished, very well-established scholar to share his view on this issue with us. We know that Dr. Mohan has a very long and distinguished career in the bank industry. He's now a distinguished consulting professor at Stanford University. Before that, he was a deputy governor of the Reserve Bank of India. And he has done so many things about this issue, and you just go through his profile, you know that. And I don't want to waste too much time here. Now let's give him a warm welcome.
Thank you very much, Professor Kuan Yew, for this welcome. I am very pleased to have this opportunity to talk about this topic here in Singapore, because a lot of the issues that I'm talking about have been very, very important for Asia as a whole. Let me mention that the paper on which this is based is co-authored with my former colleague at the Reserve Bank, Manish Kapoor. And those of you who do get interested, will be able to find it on the website of the Stanford Center for International Development. It's working paper number 399. And I think it's also on my own website, which is rakeshmohan.com. In the wake of the current global financial crisis, one of the interesting things to my mind that is emerging. Sorry, let me also say that I have a colleague from McKinsey, Ling Wai, who is helping me with the slides. There should be some approximate correspondence between what I'm saying, what you see on the slides, because I find I speak much better when I don't look at the slides. But he's very kindly agreed, so I think he must have to read the paper also to be able to do this. So thank you very much for helping me. So what you'll see, so you'll have to listen to me and look at the slides, and not just look at the slides. The basic point I was saying is that in the wake of the current global financial crisis, is that it's very interesting to look back, and we have two major sources to my mind. One older source, Charles Kindleberger wrote a book called Manias, Panics, and Crises. I think the first edition was 1978 or 80 something of the order. It's now, I think it's in fourth edition, and it's been updated each time. And then there's a new book that has just come out by Rogoff and Reinhardt called This Time is Different. And actually, Rogoff and Reinhardt's book really covers roughly similar material to Kindleberger's book. The difference is that Rogoff and Reinhardt have put together all the data also, which Kindleberger's book did not have. And one of the things you find very interesting, given what has happened in the world, is that these things have happened again and again according to Reinhardt and Rogoff, for 800 years. And they claim to have data for 800 years, actually. And there's something common in a lot of these crises, which is they almost always start with a credit and asset price boom. And then something happens when the bubble is broken. And many, not all, but many of the credit and asset price booms have actually been associated with large capital flows, cross-border capital flows coming from abroad, and then there being a sudden stop for some reason or the other. And what these things always do is that there's a real exchange rate misalignment. You have unsustainable current account deficits. Some features, not all of them, but some of these kind of features. Often inflationary pressures because of large capital flows coming in. You have overheating of the domestic economy, financial imbalances. And so then you emerge with the full-blown financial crisis. as I said, capital outflows. And then in the real economy, of course, all this is accompanied by employment and output losses and fiscal costs. And we can observe all this happening in the global financial crisis currently. And to the extent that we do have currently a reasonable degree of optimism in terms of the financial crisis having subsided, financial markets getting some degree of normality, but the employment and output losses, of course, will never be recovered. You might recover to a point where you come back to, or rather you are likely to recover to come back to normality in the real economy, but you'll never recover the losses that have taken place, and of course the huge fiscal costs. And what you find in the more recent 2 decades is that about 15% of the episodes of large capital flows have actually ended in crises. And therefore, I thought this is a very important issue, and I've been working on this. Because it's very difficult to understand. When we know this, not for the last 5 years, 10 years, 15 years, 20 years, but maybe 100 years, maybe Willy Reinhardt for 800 years, Rogoff and Reinhardt. In this context, what is most interesting in the current crisis, the current episode, is that this time the crisis, of course, has taken. We've been used to crises the last 30 years or so, in emerging market countries, developing countries. And then something happens in the rest of the world. This time, of course, the crisis has taken place in the heart of the advanced economies. And the most curious thing is that Asian and Latin American emerging market economies, without exception, despite the fact that they were not decoupled, which some people claimed early on, they were not decoupled at all. They've been hit quite hard by the crisis through the trade channel, through the capital market channel. So they have been hit quite hard. But what is most interesting is that almost without exception, and I don't know of an exception actually, that Asian and Latin American EMEs, their financial sectors have all been safe through this crisis, despite the large real economy hits. And so then you look at what is common among these countries the last decade or so, and I think the answer is, and this needs much more detailed research really, I think the answer is that almost all the Latin American and Asian emerging market economies have actually managed their capital accounts to varying degrees. The capital accounts in general are not totally open. And same thing that they've also, of course, therefore they have intervened in the foreign exchange markets. So whereas the exchange rates have not been rigid, but they've not been free floats. So they have done some degree of management of their exchange rates. So they're not at the either end, which has been advised by many academic economists, international organizations, etc. That the view has been that you can either have a fixed exchange rate, a currency board, or you can have a total float. You can't be in the middle. The advice has also been that you should have a totally open capital account, and it's only if you do this that you can have an independent monetary policy, which is called the impossible trinity. So, and in fact, of course, advanced economies do exactly that. They have totally open capital accounts, they have free floats, and of course, they then have an independent monetary policy. But what the EMEs, to my mind, have done is to question that, and over the last decade, particularly since the Asian crisis, that they have, in fact, as I said, done the middle way. Their capital accounts are more open than they used to be, but they're still managed. And the exchange rates are more flexible than they used to be, but they're still managed. And the outcomes really is, well, if you see the last decade, and most amazingly for Latin America actually, that they've had macro stability, financial stability, inflation has been down, and growth has been high. So against this backdrop, what I'm going to do is the following. First, slightly reversing the usual sequence, that I will first talk about the stylized facts in regard to capital flows to the EMEs over the last 3 decades, particularly focusing on Asia. Second, a little bit of a review of the theoretical and empirical literature on the benefits of capital account liberalization on growth. Then talk about what's the kind of management of the capital account that different countries have done. Really a snapshot of that because it's very complicated, different countries do different things. Talk about the need, the sequencing, and the effectiveness of the capital controls. So let's first go, I'll try and quickly go over the data. What is interesting is that that if you go back actually for 30 years or so, say until from the early 1980s, I should mention in the parenthesis that how I got interested in all this was that in early to mid 2007, I was asked by the Committee of the Global Financial System under the BIS, the CGF, the CGFS under the Bank for International Settlements, to chair a committee, a working group of over 25 central banks to look into this issue. And at that time, the issue was excessive capital flows, huge capital flows to emerging market countries, and then the reverse flow through the reserves, which is bothering everyone. As it happened, I took about a year and a half to work on that, and of course, as 2008 came along, the whole thing reversed. So I took longer than otherwise I would have on that committee. So that's the background, and those of you again who are interested in this, you can go to the BIS website, look at the CGFS. There's a full report of that particular working group called, I think it's called Capital Flows to Emerging Market Economies or something like that. But it is by doing that work that I found a lot of these things. The first piece of sort of data is really that what has been happening since the late 70s, early 80s is increasing magnitude of capital flows, cross-border capital flows to emerging market economies, and increasing volatility. So the average for net inflows to emerging market economies in the 1980s was around $8 billion. And that looks, small potatoes now. Even with those kind of flows, which are mostly debt flows, Latin American countries got into difficulty. In the 1990s, until the Asian crisis, the average was about $130 billion, annual average, to EMEs, most of it to Asia. And then we had the Asian crisis. Then the average came down to around $60 billion in 97, 98 to 2002. And then again it started up, and the average for 2003 to 2006 was $200 billion. And the peak, of course, was about $600 billion in 2007. So you can sort of see that it's been a rise, the curve has been like this for emerging market economies. And the projection for 2009 until early this year was an net outflow of $190 billion in 2009. Of course, we'll only know at the end of this year what has happened, because now capital flows have actually returned. So I'm not sure whether that will actually come out to be correct. But even suppose there's a net outflow of say 100 billion rather than 190, you have a reversal of from 600 billion 2007 to 100, 150, 190, whatever it emerges in 2009. So there's this huge volatility. One of the there are a couple of other features that are of interest. The first is that the nature of capital flows has changed over time. So that, as I said earlier, 1970s, 80s was mostly debt flows. In the 1990s, it's been more equity flows, but also debt flows. The third, in the 2000s, actually, what is interesting is that to some extent, the Asian EMEs and Latin American EMEs learned from their previous crises, and they have done much better management. In this decade, the greater volatility and the greater huge flows relative to the economic size has been to the CIS and Eastern European economies in the Baltics. And again, what you can see is it is exactly those countries which have the worst crises as a consequence of the global financial crisis now. It's exactly those countries which did not heed what happened to EMEs in the previous 2 decades. And so they had open capital accounts and either currency boards or completely floating exchange rates under the advice from the usual suspects internationally. They followed the usual suspects and they came proper in this decade. That is sort of the overall capital flow picture. As far as emerging Asia is concerned, what is interesting is actually that in absolute amounts, in terms of $1 billion, the 2007 peak was only marginally higher than in 1996. As a proportion of GDP, of course, it was much lower. It was almost half of what it was, except for India, which is an outlier. And that I only found post facto, because I was in the saddle at that time in 2007. I was struggling on a daily basis and what the hell to do with these dollars coming out of our ears. And only find out post facto that we were a real outlier in the sense that we got about $100 billion net which is just under 10% of GDP in 1 year. And it was a miracle that we actually were able to cope with it. The other difference is that it's basically India and China which have been getting large net inflows over this past decade, and India is different from the previous decade. The third thing that is interesting in the current episode of the 2000s is that underlying the sharp expansion in the volume of net capital flows has been even more significant growth in inflows and outflows. That is, if you look at, normally most of us are usually looking at net flows. It's actually very interesting to look at gross flows also. And the reason for that is that net flows, we sort of look over a quarter or over a year, over 12 months. But a lot of things could have been happening during that period. And so it could be, for example, that you could have had, just for argument's sake, you could have had $100 billion $100 billion gross inflow in the first 6 months. You could have had, net inflow in the first 6 months, $100 billion net outflow in the second 6 months, and you'll still see zero if you look at the annual accounts. Whereas the exchange rate could have shot up like this, and shot down like that, if that happened. So it's also interesting to look at gross flows, and on this, Asia is different in that if you take the EMEs as a whole, the gross private capital inflows went up from about $200 billion annually in 1998 to 2002 to $800 billion in 2003-06, $2 trillion in 2007. And obviously, the net figures I talked about, you'll get if you just look at the outflows. So there were very large outflows taking place, particularly from Asian countries. So about $100 billion during 1998-2002, about $600 billion in 2003-06 is the annual averages, and $1.5 trillion in 2007. So 2007 was just something completely out of this world. The planet seemed to have changed in 2007, and then it came down to Earth in end of 2007, early 2008. So the only thing to also look at is gross inflows and gross outflows on a day-to-day basis have a larger impact on exchange rate movements and expectations relative to net flows, and those expectations sort of feed on themselves in that when you have large capital flows taking place, the exchange rate tends to appreciate. So obviously from the point of view of the foreign investor, he sees exchange rate appreciating, the more you want to put into the country because you're going to earn much more. So it becomes a self-fulfilling until there's a sudden stop and reversal, and then everything sort of reverses. One of the reasons for these higher outflows, sort of in and out, of course, is that it is during this past decade after the Asian crisis that there has been a greater role for portfolio investors on the back of increased financial openness in most of our countries. And also, of course, increased institutional investment by pension funds, mutual funds. Then also the large non-profits in the United States suddenly discovered emerging markets in the last decade or so. I have been associated with Yale University. There's a President's Council on International Activities. So it turns out it is a Yale endowment fund, which in fact led the way of looking at on emerging markets. And one of the people who influenced was Antoine von Akmel, who actually has a book on this. So this also is sort of new discovery. It's like Columbus finding America. The non-profits in the U.S. Suddenly found the emerging markets where a lot of money can be made. It's all good for all of us because the endowments increase of the best universities, more professorships, more students, more grants, etc. So that's been very good for all of us. So that's the kind of thing that changed in the last decade. The other important thing which I hadn't realized until more recently is that actually, despite these large volumes of global capital flows to emerging market economies and vice versa, looking at the current global crisis, a similar thing actually in greater magnitude was taking place among and within advanced economies. So the global capital inflows amongst a group of advanced economies was about 5% of GDP in 1998. 2007, that got up to 17% of GDP. And it's very interesting. There are some papers by Milesi Ferrati and his colleagues from the IMF which actually compile these numbers very well. And it's this huge increase in cross-border flows among advanced economies to a certain extent, which has caused problems in advanced economies. And there was a huge, large increase in the stock of external assets and liabilities. For the advanced economies, again, if you look at the total stock of external assets and liabilities in 2007, it was exceeded 200%, around 220% of their collective GDP. It was twice the ratio a decade earlier. So this business of this money sloshing around, and the speed, of course, increased, presumably because of new technology, etc. For the EMEs, taken together, the external liabilities rose from about 70% of GDP in 1998 to about 88% in 2007. So the increase wasn't the kind of magnitude increase, order of the dimensional increase that took place among advanced economies themselves. And over the same period, external assets actually went up faster, from 57% to 88% of GDP of the emerging market economy, obviously because of the reserves being invested back in the advanced economies. So this is the kind of world in which we have lived over the last decade, and naturally there's been much more volatility in everything, whether you take oil prices, whether you take exchange rates, even though it was called the Great Moderation. I'll come back to that. So just to summarize this part, why has this happened? There's been both push and pull factors. Pull factors from the emerging market economies, clearly a growing degree of financial openness among almost all our countries. Strong growth prospects as seen by all concerned, both in Asia and Latin America. Inflation containment, that this is particularly true of Latin America. Asia, apart from a couple of countries, we've always had relatively low inflation, but even that came down over the last decade compared to the previous 2 decades. Latin America, of course, it was almost like a revolution of the positive kind, that they had hyperinflation on a regular kind of basis. Now, over the last decade, they're basically in single digits in terms of inflation. So obviously, the risk has come down in investing in Latin American countries. Also, overall increase in productivity across the board. Also, a good deal of corporate restructuring across the board. So again, one of the interesting things in the current crisis in Asia is that despite the huge export hit that has taken, trade hit that has taken place, and all the other disturbances that have taken place, capital market disturbances, we don't yet hear of large corporate bankruptcies in Asia. Certainly not in India, but to my knowledge, we don't observe large NPLs taking place, which is why the financial sector has also been safe. What has happened is the corporate sector in Asian and Latin EMEs has also got much more healthy through the restructuring of their balance sheets and reducing their leverage, which used to be very high in Asia, particularly before the Asian crisis. And again, this has helped in foreigners getting greater interest because you can see the health of the corporate sector in Asia. One other general point from the point of view of EMEs is, in terms of a pull factor for investment coming in, is despite inflation having come down, if you take the average inflation in EMEs over the last decade, you will find it in the region of 5-6%, something of the 5 to 7%, something of that order, depending on what period you take, which countries, etc. That is still, and for the until the crisis, for the advanced economies, it's been something like 2 or 3%. So you still have 2 to 3%. The only way I can describe is sort of a structural difference in inflation. I don't have a good explanation for that, or at least let me put it this way. I don't fully understand why that should be so, but it is. As a consequence, nominal interest rates are also 2 to 3% on average higher in EMEs relative to advanced economies, and so therefore there's a structural nominal interest rate differential, which also draws in arbitrage money. And again, it's a self-fulfilling thing in the sense that normally what one expects is that if you have that kind of inflation differential, you'll have the exchange rate will move, and so you'll have covered interest rate parity, And so that will sort itself out. But what really happens in real life is that you see higher nominal interest rates, you invest in there because you see a higher return. Because more foreign exchange flows in, the exchange actually tries to appreciate. And so more flows in. Again, the reversal takes place at some point. It can't go on forever. But in the meantime, you have a lot of volatility. So that's another pull factor. From the push factors, one major issue actually is that this story that I've given on increasing magnitudes and fluctuation of capital flows from advanced economies to emerging market economies over the last 30 years mirrors what happens to monetary policy in advanced countries led by the US Fed. As long as I was deputy governor of the Reserve Bank, I couldn't say much because there's an unwritten convention. You don't talk about your colleagues elsewhere. I can't throw stones at the US Fed because they will then throw stones at me. Now that I'm freer, I'm still careful because I'm still newly free. So what I do now is to quote John Taylor. So I can hide behind his skirts. Well, he doesn't wear skirts, but I can still hide behind him. But he has done much more careful work, and as sort of a guru of monetary economics, is a good person to hide behind. So he has done much more work in that, and he's basically shown on how the US monetary policy, particularly after the dot-com bust, went on loose for too long. And actually, we had done this work in the BIS working group, and what we found was that very roughly speaking, you can go back to the early 80s, when the big Volcker tightening took place. When the big Volcker tightening took place, that's when the reversal took place. Interest rates shot up, and that's when the first Latin big crisis took place. Then, after the Volcker tightening, there was loosening, and then the capital flows flowed out again from advanced economies, and you had large capital flows to EMEs. Then they again tightened. That's when the Asian crisis took place. And the same thing has happened after the dot-com crash. It loosened tremendously, and capital flows increased all over the world, as I said, among the advanced economies themselves, and then the crash took place when they started tightening. The same thing happened this time. As soon as the Fed started tightening, you had the subprime crisis, because with the loose monetary policy, there was a huge amount of lending, etc., credit boom taking place in the US. Just as you started tightening, obviously the reverse happened, and this time in the core economy itself. From the point of view of EMEs, obviously we have no control over what happens out there. We can only see the impact of that on us. And to my mind, what EMEs have been doing is cushioning themselves through what I described earlier. I'll come back to that later in a little more detail. The other issue that is different, so I should mention, one of the things you observe, if you observe US monetary policy relative to other major countries, is that it has much more volatility in itself. The US Fed somehow goes up and down much more. The magnitude of fluctuation is much more in their policy interest rates. I'm still not saying that what they're doing is wrong, because what they could be doing may be correct for themselves. I don't know that. I can't make a judgment on that. But I can see the effect it has on me. And therefore I have to react, or we have to react, what happens to us. One other difference in the last decade, of course, particularly for Asia, is that so far I've only been talking about the capital account. Until after the Asian crisis, EMEs almost always collectively had a current account deficit. The difference after the Asian crisis is that apart from India, most Asian EMEs have had current account surpluses. So in addition to the capital account, capital flows, the other difference, of course, has been the current account surpluses, where savings have been exceeding investments in Asia. And so in the last 5-6 years, this huge increase in reserves has taken place, with current account surpluses being added on to capital flows. if you go within the components of the capital flows, what you also find is that the FDI is relatively stable, and it has relatively stable even through this crisis to EMEs. India, actually, the peak year of FDI was in 2008-9. Portfolio flows have been much less stable. They are much more volatile. Portfolio equity flows. Debt flows even more unstable. And even more unstable are the bank borrowing, international bank borrowing. That's sort of the hierarchy of instability that you can see. Another issue relative to that is that capital account movements are much more volatile than current account movements. So current account movements emerge from the real sector. Real sector doesn't go up and down like that, which is why, in some sense, watching capital flows is much more important. I'd already mentioned the issue about that India was somewhat of an outlier. In 2007, the net inflow to India was $108 billion, which is a little under 10% of GDP. For China, in contrast, it was $70 billion. So in 2007, actually, India received higher net capital flow than China. The reserve accumulation, of course, is much higher because there were huge current account surplus. Other Asian EMEs actually put together, the net inflow was on balance zero. So there were large outflows taking place also, particularly from countries like Korea. Then you go looking at the sort of savings investment side. What you observe for Asia is that prior to the Asian crisis, Asia had large current account deficits. Investments are much higher than savings. After the Asian crisis, and this is, and then Ben Bernanke has made this a common issue, what he called the savings glut. Actually, what you find is that savings didn't go up in Asia or anywhere else. Savings have remained roughly stable in Asia. Investment that went down, except for India and China. And you can also see the difference in that, the investment ratios went down for most Asian countries. So, of course, S minus I became positive, and therefore your current account surpluses. In China, everything happened. That is, savings kept on going up, investment also went up, but the gap started increasing, so you have very large current account surpluses. Only in India it was the opposite, that we all continued to have current account deficits, but capital flows increased tremendously. And in terms of growth rates, this is a somewhat different perspective, in the sense that it is Indian and Chinese growth rates that increased after the Asian crisis, particularly India's relative to its previous performance, while most other Asian growth rates declined, but they still remain respectable. It is not the case that they were low relative to the rest of the world. So as I said earlier, India is an outlier, and it's a good subject for research on why India was an outlier, what was something special that happened in 2007. The other thing that one is useful to look at, actually, because there's a lot of, one issue that is considered is the savings glut, which I've talked about. Then the issue of exchange rate rigidity in Asia. China, we all know what their policy has been, but even for that, one would say that their exchange rate was much more rigid in the previous period, whereas they had been appreciating since, I think, 2004, Sunil, I think we're about 2004 or so, until last year, when they again got rigid after the crisis. So their flexibility was higher than the previous periods. So ascribing the crisis to their exchange rigidity, to my mind, is questionable. That it is rigid, we know, relative to other countries. But Asian countries in general have been more flexible than earlier. There's been a generalized pressure on exchange rate appreciating in Asia until the crisis. So to summarize, capital flows to EMEs as a group witnessed unprecedented rise in 2003 and 2007, more open capital accounts, huge surpluses also in the current accounts in case of a large number of countries. Now large outflows have taken place in 2009, and with this huge volatility over short periods of time, most EMEs just manage their capital accounts, capital controls, forex intervention, etc. And they've had more foreign exchange rate liberalization. Coming to theory, basically, the theory says that capital accounts should be open, and that the less developed countries or emerging market economies, developing economies, would benefit from capital flows because they get greater access to resources, and therefore they will grow. It will be growth enhancing, and there is consumption smoothing because there's domestic volatility and you have consumption smoothing with resources flowing from abroad. There's eons of paper written on this. We can look at different way people put this here differently. I've given a very small snapshot of it. The empirical evidence, and this is what I find most interesting. Almost anyone who has done research on this, various papers from the IMF, other people like Raghuram Rajan, Prasad and Subramaniam, Roderick and Subramaniam, Peter Henry, who was at Stanford, he did a review article for Journal of Economic Literature last year, Coase et al. From IMF, isn't it? And others, Obstfeld and Rogoff and so on. Not one of them, without exception, not one of them can find empirical evidence between positive correlation for volume of capital inflows and growth. Not one of them. And these are all the best sort of people you can think of. Rather, in some of them, people find the reduced reliance on foreign capital associated with higher growth, and you have these real appreciation pressures. The second issue, empirical to my mind, in the last decade is that when the EMEs have had resource surpluses, so that they're exporting capital out, you can hardly talk about their benefiting from more capital coming in. There can be discussion about their markets becoming better, etc., so that they use their own resources better. But it's really difficult to argue that they would have gained by having more open capital accounts, by more resources coming in and being intermediated. So what is most, and the evidence, however, is the opposite. As I said, for 800 years, that total capital account openings often follow financial crises. Large capital inflows result in booms, real appreciation, current account deficits, loss of confidence in capital outflows, and financial instability. Then what happens is that a lot of the observers, a lot of the sort of theology, if I can say, of our profession, my profession, that is economics, the theology refuses to believe that capital accounts can be not associated with positive results, open capital accounts. So then the theologists descend to saying this can't be true, so there must be other, what they call collateral benefits, institutional development, financial sector development, better governance, etc. I'm obviously characterizing in extreme fashion to make the point, because there are some positive results do take. I can say in India that our opening of portfolio capital flows to our capital market have certainly improved governance in our companies. There's greater transparency, institutional development. All that is correct, but that's been with a limited opening, not a full opening. So it is very interesting that a lot of the empirical work just does not provide evidence of the theory being correct. Yet economists refuse to give it up, and that's an issue that I don't understand as an economist, why economists are not looking at their own evidence and from the high priest's evidence, not some side fellows doing research, some sidees, as we say in India, doing research. I said, is the high priests doing research, do not find the positive correlation, and yet even only last week the IMF managing director finally actually had to say that he wasn't against capital controls, because his institution has been against capital controls for the last 10 years. He finally had to say that he did not have a view. And so this is something different that has been happening. But what the evidence does find, again, is interesting. That they do find generally positive correlations between equity flows and growth. And within equity, positive correlation between FDI and growth. Less positive correlation between portfolio equity flows and growth. And certainly debt flows are found generally to have a negative impact overall. One other issue in terms of the exchange rate volatility, in terms of now coming to the issue of exchange rate being completely floating or partially managed, from the emerging market point of view, as a general issue, our exports are much more labor intensive. As a general issue, of course, there's a huge variation within a country, between countries. But as a generalized point, emerging market exports are more labor using than advanced country exports. They're also much more commoditized. So that, when you go and buy a shirt or a pair of trousers or toys, you really couldn't care less where it is made. You look at the quality and the price. And the quality is easy to get now. Lots of these commodities, lots of these goods. So the exchange rate is the real exchange rate and the nominal exchange rate, both much more important in terms of low volatility for the real economy, the emerging market countries, because they are much more competitive markets. And from the point of view of a particular country, if you allow a large appreciation or depreciation, the large appreciation in particular, your exporters might be losing some market, which they can never regain, even if exchange rate comes back, because they're highly competitive markets. And therefore, it's more important for emerging market countries to have something of a managed float while having flexibility. There's no issue. I think one of the things that the last decade has proved that neither agility is good nor a full float is good. So it is good to have a certain degree of flexibility. You don't know ex ante how much flexibility. So you need the economies to adjust to flexibility in the exchange rate. One of the other things that is said is that you can cope with these flows, the volatility both in the flows as well as volatility in the exchange, if you have developed financial markets. I think one thing we've seen in the current crisis, even that is not true. The world's most developed financial markets could not cope with the kind of volatility that went up among themselves in terms of capital flows. Their financial institutions could not cope. So even that, it seems to me, is incorrect. We've also, among emerging market countries, as I said right in the beginning, that you can see that among emerging markets, who suffered the most? The Baltics, Eastern European, CIS countries. Among EMEs, that was the region which was the most open and not managing either the exchange rates or going to a currency board and not managing the capital account. And they came a cropper. So that's the, I've really quickly gone over the sort of theory and evidence. It seems to me the position is very clear. And what is interesting is the IMF also now has some papers acknowledging these kind of results. After looking at all this evidence, what you find among EMEs is that they seem to have followed these results relatively faithfully, in the sense, again, that you'll find differences between different countries within Asia, across Latin America, etc. But broadly speaking, most EMEs have followed this hierarchy. Most liberal on FDI, then on portfolio equity flows, then on portfolio debt flows, and there's a sort of hierarchy they have been following, and they've tried to deal with hot money in this fashion, and they've responded. Then on the outflow side, again, this is generalization. You'll find you'll find different experiences in different countries, and I'll come back to that point in a minute or two. That on the issues also what you do with outflows. We don't inflows most of the time. That what we have done in India has been that in the hierarchy of outflows, we first released the corporate outflow, because the idea was that if Indian companies want to get the benefit of diversification abroad, we should not stand in their way. So now it's a pretty liberal regime in terms of Indian corporates investing abroad. Then institutional investors, so then we released mutual funds, etc., to invest abroad, and only finally individuals. And that also has some certain limits. The differences between countries in this, but again, broadly speaking, this is a hierarchy I think that many countries have followed. Then a lot of the theoretical and empirical literature says that, but capital controls are not efficient. The problem in a lot of the literature and work is it's very difficult to actually do this work because it's difficult to measure the actual degree of capital account variation in terms of controls. So that you would, in most of the literature, you will find, for example, that India is treated as closed. But actually, I showed you, it is an outlier in terms of how much went in over the last few years, particularly in 2007. So it's very difficult to do this work. And again, I think that researchers, I do believe, can find ways. They'll have to look harder and look more into individual countries' experiences, what they've actually done in terms of capital account controls. The latest thing is, of course, you would have seen last week Brazil put a 2% tax on capital inflows. It remains to be seen. This is also a very interesting issue. That can we do capital account management through price mechanisms? I put a tax. Now, all that the tax is doing, so that I can see, is it's doing a multiple exchange rate. There's a different exchange rate for money going in to money going out. They have accepted FDI from this tax. And how much difference will a 2% difference make between inflow money and outflow money in terms of exchange rate? So I think this is also an interesting issue in principle, that can you do this management through price mechanisms, or you do have to come down to some kind of quantitative controls. One of the other issues in principle that arises on how you do the management is that, if I may put it this way, that theoretically or in principle, if I believe that the capital inflow from the rest of the world to your country has gone up on a permanent basis. Why would it have gone up on a permanent basis? Because the rest of the world believes, and it is true, that your productivity is rising on a permanent basis relative to the rest of the world, right? The problem on a real-time basis is you don't know what is temporary and what is permanent. I can say from our experience, 2003 to 2007, very increased volume of capital inflows. During that period of time, it's difficult to believe it won't be permanent. But it reversed in 2008. And we had to reverse all kinds of things to cope with the outflow. So there is an issue here in terms of actual macro management. So you need to think of devising instruments which you do in real-time basis, and then you reverse them after some time. That it's only post-facto basis can you know it is permanent or temporary. If you look at the actual instruments used by EMEs in Asia, they've used different countries have different measures. For example, there's been flexibility in the use of controls, inflows and outflows from different countries. The inflexibility in exchange rates to different degrees. Sterilization of exchange interventions to different degrees. Also, for example, India and China both use the increase in cash reserve ratios as a matter of controlling banks, credit expansion, etc. So you find a huge variation. Similarly, Thailand, for example, used the method of unremitted reserve requirements. We have used modulation of interest rate ceilings on non-resident deposits, and so on. So I won't go into all that detail, but the main point is that there's a huge variation in what different countries have done, but they have used, a lot of countries have used a number of non-price mechanisms. And the way I would put it is that, look, here the best may be the enemy of the good. You're using second best techniques of managing, but you're managing. And you have to make those judgments. Time tells what instruments are better and what instruments are less good. And this is where it seems to me that more research is needed in terms of which instruments work better, rather than saying they're all bad, and the regulators are stupid, and that authorities can't make such judgments. One basic issue which I should have mentioned is that it is the banks contracting foreign liabilities to fund domestic assets is usually the worst sin. Asian countries learned this very well, other Asian countries, except for Korea. They got into trouble again. Only the Korean banks in all of Asia got into trouble because of excess foreign liabilities. And this is really shown in the experience of the Baltics and the Eastern European countries, where their banks used foreign credit, foreign liabilities to fund domestic assets, and got into real trouble. The other thing you find among the Asian countries and also Latin American countries is that they've not been afraid to use all kinds of counter-cyclical tightening and rollback of provisioning norms and various prudential norms to the financial regulatory system on their financial institutions, particularly banks. And what is interesting is that some of these things are now post facto being talked about the G20 by the Basel Committee, etc. What Asians have been doing, India has been doing, Singapore has been doing, and Latin American countries have been doing in conjunction with overall management. What is interesting to me in all of this is that the eating, what is the proof of the eating is in the pudding, or the proof of the pudding is in the eating. That's the proof of the pudding is in the eating. I should get this right. And if I don't stop very quickly, you'll come to the pudding stage and you don't even have time for dinner. So, but the interesting thing is to look at the outcomes of Asian countries in particular, but Asian Latin countries both. Asian EMEs, despite large foreign exchange interventions, have been able to maintain monetary and price stability over the last decade since the Asian crisis. Although the operating target in most countries has been the short-term market interest rate, overnight market interest rates have broadly remained in the kind of policy corridor or policy target that they have set. Monetary aggregates have behaved relatively well. So the central banks in Asia have actually been able to insulate the growth in their monetary aggregates from large purchases of foreign exchange. So they have succeeded in a good deal of sterilization. The point of all this is that I don't have time to go into the detail to do a different lecture on monetary policy overall, but the point is that the corner into which we've all been pushed by academia and otherwise of going into the tight corner of inflation targeting and only using one instrument, that is short-term interest rate, is also not correct. That what EMEs have done have been actually looking at monetary aggregates and doing something through cash reserve requirements, other methods. Again, they vary from country to country. So they have been doing some form of inflation targeting, a real focus on price stability. You can see that in the outcomes, that they've really succeeded in bringing down inflation. But the instruments they've used have been broader than what is advocated. So I'll just conclude by sort of motherhood and apple pie statement. The optimal response to large and volatile capital flows is really a combination of sound macroeconomic policies, prudent debt management, greater exchange rate flexibility than less exchange rate flexibility, but not a complete float, greater opening of the capital account than a closed capital account, but not a completely open capital account. There is value to the accumulation of reserves of self-insurance and also to manage the reversals, despite advice to the contrary. Although there are limits to that, every good thing has a limit. Also, I should mention right at the end that while doing all this, we all need to continue to develop our domestic financial markets so that then the authorities have to do less. That there's no question. The more flexible the financial markets, the less the authorities have to do. And final comment, and I've tried to emphasize this all through, that there is no one-size-fits-all. There are certain regularities, certain generalities you can observe, but different countries have different instruments and different traditions. I've gone over by about 15 minutes, but sorry, I couldn't stop.
Thank you so much, Dr. Mohan. It's a very enlightening lecture, and I believe we have some questions. Now the floor is open, and Dr. Mohan would like to entertain some questions. Please identify yourself and be as brief as possible. We have roughly about 20 minutes.
Hi, my name is Ghanshyam Ahuja. I'm from IT industry. You mentioned about that there is no correlation between capital inflows and the growth. Uh, I could not understood fully. Is there any? I mean, there is no growth in any sector. Say for example, what comes to my mind is okay. The financial sector may be growing because of inflows.
I'm not talking about any sector. I'm talking about GDP growth overall
okay.
and net flow. I'll take 30 seconds to see the general. The general understanding we need to have from macroeconomics, right, is that growth is related very clear to level of investment overall, gross domestic investment. Now, if it is the case that I can run a current account deficit of some magnitude, that is the level at which I'm actually absorbing foreign inflows. So suppose I have a current account deficit of about 2% of GDP, for example. Suppose that's $20 billion, right? Then I can happily absorb $20 billion, and my growth is benefiting from that $20 billion, and I'm absorbing it, right? But there is a point to that at some point I have to pay back. Because capital flow is coming how? Either as equity. Equity is not free. In fact, people expect a higher return on equity than on debt. So at some point I have to pay back. Similarly with debt, that I'm paying the flow that is interest rate. In any case, at some point, the principal has to be paid back. So if you do a study over 50 years, it has to even out at some point. That's my simple understanding of why people don't find a correlation between net capital flows and growth. Over some period of time, you might find, for example, you can take Korea actually. Right through the 60s and 70s, roughly speaking, for about 2 decades, they had a net inflow of something like 7-8% of GDP. First through debt and later through equity. And they clearly gained during that period. I think if you just took 20 years of Korea, you'll find that correlation without a shadow of doubt to my mind. But if you look at 50 years, probably you won't find it.
Right, Hyun-Lee from APEC Secretary, working for Policy Support Unit, which is a newly established think tank for APEC. Actually, I have a comment that relates with the correlation between the capital inflows, net capital inflows, and economic growth. Well, you may be right, but we have to be very much careful about the correlation between capital flows and GDP growth rate. If you look at actually total capital flows, there is a very high correlation between, with GDP growth rate. And one thing for sure also is that actually the openness of capital market has a very strong positive correlation with the, GDP level, per capita GDP level. And to some extent, even it has a strong correlation with the growth rates as well. And I also would like to, comment that actually we have to look at specific kinds of capital flows rather than just looking at the overall. Actually you have different correlation between equity flows and GDP growth and debt flows. That's what you mentioned. And also I'd like to mention that, well, actually, this is very much similar to the relationship between actually trade of goods and economic growth. There has been some study looking at sort of the link between actually, trade of goods and economic growth. Well, you say that, well, there's no sort of, concrete sort of finding that supports the, positive correlation between the trade volume of goods and I mean, there's some studies like that. But what I'm saying is that actually we have to be very much careful about that. One thing for sure, again, is that, well, we have a very strong evidence that, market openness, financial market and goods market, both, has a very strong correlation with the level of welfare or GDP.
This I want to address very straightforwardly. There is no question that there is high correlation between trade openness and growth. There is something on which, there's one issue on which all economists agree. On financial openness, people are not able to find correlation. I think that I'm saying that's not my work. You find a paper, and please send it to me. all right, empirical paper on financial openness and growth. What is correct, what you stated was that you will find a correlation between the degree of financial openness and the level of the GDP. More developed an economy, the more financially open it is, no question about that. Okay? But the causation is probably the other way around. The causation is the other way around. That is, the more developed you get, as your financial markets get more developed, there is a higher there's a higher capacity for your financial markets to be able to cope with the kind of volatility that takes place in capital markets. Okay? The argument has been the opposite, and that's the issue. The third point I want to make is that I want to be very clear on this also, and I will try to repeat it a number of times intentionally, which is I should not be taken to mean that I don't want to open capital accounts. I've been very careful on that. I've said repeatedly that you need an open capital account, but not totally open. You need to do some management of the capital account. That depends from country to country. And I think one example is Korea, that it has a much more open capital account than most other East Asian countries. Apart from the accident they got into because of their banks' exposure to foreign liabilities, everything else has worked very well. Their capital markets have become much more sophisticated over the last couple of decades, particularly over the last decade. So that is also correct. And as you said, there are differences in degrees of different kinds of capital flows. There is a hierarchy in equity, FDI, portfolio, then debt, and then some other things.
Thanks, Charles Adams. I just wanted to raise a question to be a little bit provocative. You began by saying the solution is you manage exchange rates, you manage the capital account. The list of conclusions you have sounds to my mind pretty conventional, except for item number 4, which is effective management of the capital account. I'm not quite sure exactly what you mean by that, because to my mind, just about all the other points would have come out of the IMF for many years. So I wonder if you could clarify whether this is saying that you support a more activist role for capital controls, and if so, isn't part of the problem with managing capital flows that on the one hand you can put controls on and the like, but if you're trying to develop your domestic financial sector, your domestic financial markets, there are trade-offs. And somehow getting the balance right is the challenge. And yes, you could block all capital flows, you could put taxes on, but you would probably inhibit the growth of the very markets you need to manage the risks that come with capital flows.
First of all, I never claimed to be non-conventional. So if you say it's conventional, I'm quite happy with that. I have no problem with being conventional. I've always been conventional in my life.
I was using the IMF as the conventional benchmark.
However, you will recall that in the late 90s, the IMF explicitly advocated exchange rate management. You can either be at this end or this end. That is, you can either have a currency board or you can have a float. They got Argentina into trouble through the currency board. Argentina was an IMF darling on the currency board. Okay? And they got into real trouble because the currency board could not hold. Number of politics today are trying to hold on to the currency boards and they're in real trouble. And again, it's the IMF gets business from them when they get into trouble. So it's been shown without a shadow of a doubt, the only successful currency board around now is Hong Kong for a long period of time. Second, those who had complete floats have also got into trouble. And the IMF itself now, in a recent paper, is acknowledging this point, that they were wrong. The most recent paper they've done. even if they're not saying they're wrong, they're not saying the middle path is something that is worth looking at, which is you want more flexibility, but going to this end or that end are not the solutions. But as I said, it depends on the level of development of financial markets, etc. The second point, again, you want to push me to a corner, which is you block all capital flows. I never said that. And that's exactly what people try to argue. They always want to push you into a corner. It's exactly what you're doing. And whereas I've repeated again and again and again that one of the differences is that over the last decade, most Asian economies, most Latin economies, including India, have had more open capital accounts. But at the same time, they've been doing some management. And finally, the point about, but you have these, of course you have these trade-offs. But the answer is, what are the outcomes? Who has the best outcomes in the last decade? The countries that have done some management, they have the best outcomes. So you have to have a counterfactual to prove that wrong. But Charles, what is who heard this paper when it was first given in Tokyo?
Yes, I was the discussant.
Yeah, my name is Ko Chin Hua, member of Economic Society of Singapore. Dr. Mohan, I have a question about the rather current phenomenon, which is what they call dollar carry trade. What are your comments on that?
That is sort of the issue which I was talking about in part of my remarks. That there appears to be a structural difference in inflation between many EMEs taken as a whole. Of course, you have lots of variations among EMEs, and advanced countries taken as a whole, for which I don't have a good understanding, which is there is some inflation differential. If there's an inflation differential, if real exchange rates, real interest rates have some equalization across the board, you'll still have differences in nominal interest rates. Therefore, there's always a potential for carry trade from some developed country or the other. So there was a yen carry trade when they had the zero interest rates. Now the US has a zero interest rate, so there's a dollar carry trade. That's exactly the problem that I'm talking about. That therefore, from the EME's point of view, and where we are relatively small, even a large country like India is relatively small compared to the volumes of capital flows coming out of advanced countries. To give a specific example of that, if I remember correctly, the net capital inflow, even in the peak year, in terms of portfolio inflows to Indian stock market, is I think 25 billion or something of that order, which is peanuts for the rest of the world, even one country. But that made our stock price take off from 8,000 to 20,000. And the reversal was even less. I think it was 10 billion, something of that order. It came crashing down from 20 to 8,000. Right? So your question is very well taken, that it is exactly those phenomena which we have to bother about. And if the largest economy in the world goes from 0 to 6 and 6 to 0, then you have this kind of volatility in the rest of the world, which then I have to manage. I'm still not saying what they are saying is wrong for themselves. I don't know. They may be right for their own economy, but it has an effect on me. What I do has no effect on them, because I'm small. You'll also find that there's greater correlation in the monetary policies of advanced countries, because other advanced have no option. That when the US goes down, then Europe has to follow, because otherwise the kind of appreciation, the imbalance will take place between them will be very high. So these are, I think, the real issues. You're absolutely right. That is the issue, which is why right at the current time, that even the IMF has endorsed explicitly the 2% tax on flows by Brazil. We don't know whether it will be effective or not. 10 years ago, they would have they would have slammed Brazil for that. But even they are recognizing there's a problem because of the carry trade.
Thank you.
We have a final question, and
My name is Dipender Randhawa. I'm with the National University of Singapore. Dr. Mohan, as you pointed out, the evidence on the link between capital account convertibility and growth is fairly ambiguous at best. And most of the recent research is taking a much more nuanced look, looking at the role of institutional structures and other indicators. Now, from the vantage positions you've held both in Basel and Bombay, I'm presuming you've had access to data and insights that are not available to the rest of us, especially how
Not
the
really.
capital
I had far more staff. Now I have no staff.
or access to resources that enable you to do so.
But the data are almost all available publicly. People don't do any work.
I'm thinking in particular of the impact at the micro level, I mean, and to the extent that what you can glean from the behavior of firms that are borrowing in international markets, and there's some degree of regulatory arbitrage. And most specifically, as you pointed out, banks tend to be the villain of the piece. Firstly, two questions in there. Firstly, have you observed any cross-country regularities which may provide us with a more nuanced picture? And secondly, with the banks, there's a considerable cleavage between what the regulators desire and the way banks behave. And that's been seen time and again. Is that what's muddying the picture overall?
Those are very large, difficult questions. And the second question maybe I should give to Andrew Large, because he was much more a regulator than I was, but from the Bank of England. But on the first question, actually, on the micro behavior of firms, is a very important one, which I should have mentioned, is that it is often the case that when we say that, say, external borrowing, right, on a macro basis may not be such a good idea for the country as a whole. Right? But those firms who are able to get access to that external borrowing, and let us assume at a lower opportunity cost than domestic borrowing, that may or may not be true over some period of time, given exchange rate adjustments. But let us assume for a second that they do get the benefit of external borrowing through lower costs. Those firms are clearly benefiting. There's no question of that. I would also go further and say that by those firms benefiting and some large firms getting access to those resources, can even have signaling effects to the rest of the economy. Even you might say that, look, the animal spirits get benefit. I think all those things are true. So I think that it's a very good question. I'm glad you brought that up, because you have to keep all these things in mind, which is why I can say, as from the Indian case, that we were very careful to be as liberal as we could, with both Indian firms being given relatively liberal opportunities to invest abroad, and also to incur external debt, again within some limits. We always had some macro limits in mind, which we sometimes were able to enforce, sometimes we were not able to enforce. So a general point there also is that, look, this is all to do with the second best. And you're groping. In real time, you don't know what the outcomes are going to be. The second thing on the regulation and the banks, this is a big question, obviously, going on in the world today. My generalized comment on this is that what has been the philosophy of the last 15 to 20 years, maybe a little longer, that regulators in no way can be ahead of what the financial markets or the bank institutions are doing. Sorry. because they are smarter, because the guys in the private sector are smarter and more nimble than the regulators. To a certain extent, that's true. Obviously, people in the financial markets are looking for new innovations, etc., etc. Very difficult for regulators to keep up with them. On the other hand, I think that too much has been made of that, in the sense that the regulators have staff who are looking at these issues for a long period of time. They may not know or understand the newest innovation, but they have a good understanding of how financial institutions behave over a long period of time. They don't have to be whiz-kids. In fact, if they have whiz-kids, you'll get into trouble. You need to have a relatively high degree of capacity and capability among the regulators who do understand and watch financial markets and banks. They also have the advantage of what you were saying, you have more data, which is not to say that public data not available to others. It is that you're processing it all the time. Others are not. And you're looking at all institutions at the same time. So I do believe that much more can be done through financial regulation than is believed. Which is not to say that financial regulation should be very intrusive, should be looking at your over your shoulder all the time, etc. The only point I'm making is that this generalized view that regulators can't function is just plain wrong, because of the experience that they gain. And you have to, and of course, you have to keep doing that capacity building. And it'll always be the case that I put regulation here, you're going to, it's a job of the private sector to escape that regulation. There's nothing wrong with that. That's what you expect. But you have to keep watching and following. And in a lot of these things, whether it is regulation, whether it is capital account management, whether it is exchange rate management, I think that what we have learned through this crisis is that there are no clean solutions. But don't be afraid of making judgment. Don't be pushed to corners by economists like me.
That was a very good idea. Okay, thank you very much, Dr. Mohan, for excellent.
Let me thank Colin for